Hello, hello.
All, I welcome you all here. I feel great pleasure to introduce to you all the eminent speaker that we have amongst us today. Everyone who is in any way associated to the Indian business media knows him as an expert on technical analysis. He is a technical analysis commentator on CNBC TV 18, India's most watched business news channel, as we all know. His morning analysis is watched by hundreds of thousands of traders every day. He is the founder and chairman of S2 Analytics Private Limited. He is a short-term trader in indexed instruments. His daily newsletter is published by s2analytics.com. He is the founder cum president of the Association of Technical Analysts India. Being very active in talks of investors and traders conferences, he has participated in almost 100 of them organized by CNBC TV 18. He holds an honors degree in commerce and CFTE qualification in technical analysis. He is also the director of the international organization IFTA, which stands for International Federation for Technical Analysis. Let's have him here to share his legacy of knowledge that he has in technical analysis subject. Could we have him here? Could we have it for Mr. Sukhani? Come here, please.
Well, good morning, sir. I'm really grateful for being asked to come here and speak to you and speak with you and share whatever I can. So the pleasure of coming here is all mine. And many thanks for attending this meeting here. It's always difficult to start when a group of people more knowledgeable than me are sitting in front of me. So I get tongue-tied and I don't know how to speak, probably uh, get speaker's fright. So if I am a little awkward in the first few minutes, please excuse me. Some of you probably invest, some of you trade, many of you do not know much about the stock market, some of you think it's a gambler's den, and it is. But most of you are aware of what the stock market is in different forms, either deeply or just apparently on the surface. It doesn't matter. I'm a trader in the stock markets for many years, and CNBC, the premier TV channel in India, started in 1999, and just in the first week of their service, they called me, and they somehow liked what I was saying and speaking. So I'm with them for the last 17 years, 16 years, from 1999 till today. So I speak on television. I share my views on the market and on independent individual stocks every day. And let me share with you that it's a very tough job to do because hundreds of thousands of people listen. It's not just listening. When you listen to political channels or a lot of political, say, commentary on TV, you listen to it and feel entertained or feel angry, but that's the end of it. But when people listen to business channels, they actually put their money on the line, and that creates a lot of tension to people who speak there. Because if we say something, it means you are putting your money and either earning or losing. And if you're earning, it's very nice. But if you're losing, it hurts me a lot. It hurts me more than it hurts you. So there's a lot of stress involved. It's not just coming and having the glamour. It's also sleeping less and sleeping badly every night. But that's the job. So what is technical analysis? Most of you are here for some kind of study in financial management. So either you are experts in financial studies or you will become one, certainly proficient. Technical analysis is something which is a very small subset of the entire universe of finance. It's very small, so small that it's usually ignored. Oh, since you can all, I'm sorry? As the topic says, and it's presumptive to say this, that there are shortcomings in traditional finance. To come here in NIFM and say that aap jo pad rahe hain, whatever you are studying has shortcomings is a little unfair, but I think so. Traditional finance has a lot of limitations, and new areas and new ways of thinking are not only expanding on the limitations, but also improving and sometimes showing new pathways. Technical analysis, a relatively new field, is one of them. As I've already explained, it's a small subset, but it's there. So today, in this brief presentation, I'll cover 3 different topics. Give you a very brief introduction to technical analysis, explain how it differs from traditional or classical financial analysis, and what are the ways in which finance itself, or rather the analysis part of finance, is evolving to the best of my judgment. And finally, give you some teasers and some, not really advanced, but some ideas on how technical analysis works. See, there is a simple objective of technical analysis. It is to anticipate future price trends, which means it's very focused. It's not accounting, it's not finance for banks, it's not finance for insurance companies, it's not government finance, it's nothing. So the study of finance that you do here is probably much, much broader than the knowledge that we have acquired, which is very narrow. And that's the starting point. But it's interesting and it's useful. And if you want to forecast future price changes, it's important, probably far more important than classical analysis would be, and far more useful. Why do we want to forecast future price changes? Because we want to make investments in liquid instruments where we would like to know if the investments would actually appreciate in value or not appreciate or actually depreciate in value. It's forecasting with all its plus and minuses, but it's a tool that enables us to determine whether we want to go and invest in that instrument at all or not. Now, fundamental analysis, classical financial analysis has similar tools, and a lot of them. There's a wealth of knowledge, a lot of body of knowledge for that area. So why technicals? What are the methods that we use? First of all, the basic premise of technical analysis is that markets move on crowd perception. No matter who you are, and some of you, and most of you are aware of the, stories that technical analysts like me would like to say. One of them is the very famous George Soros short of the pound. In 1992, the British economy was in very bad shape. And George Soros, who was then a very important, a large trader, and now is a very, say, significant fund owner and manager, hedge fund owner and manager. At that time, George Soros said that the British pound is overvalued when it is compared to the British economy's condition, and the pound should be much lower than what it is. So he went to the markets and sold the pound. The correct word is he shorted the pound, the British pound. And the British government was furious. They said, how dare he do that? How dare he talk down the pound? It's our pound. I mean, obviously, everyone feels pride in their currency. And they said, we won't allow an ordinary, a mere trader to trifle with our currency. So he would sell the pound, and the British government and the bank there, the Bank of England, would buy the pound. Now you can imagine a trader versus a government, the full majesty of the government against a trader. And guess who won? The pound crumbled, the pound tumbled, and it fell 30% from its highs. The government could not protect it because it was not George Soros alone. It were many, many people. It wasn't one trader. Once one trader thought that the pound was overvalued, then probably a crowd came in. Others also thought, yes, what he says is right. And it is suggested and sort of said that he made £1 billion in that trade. That would be about, at that time, in 1992, about 10,000 crore rupees. So maybe 50,000 crore rupees at current prices. That's a lot of money even for him. But my point was that markets follow crowds. The biggest of governments cannot control the markets. If they could, then yesterday's decline in the world markets, in Europe, in America, would have been prevented. Who is more powerful than Yellen, the chairman of the Federal Reserve in the USA? Do you know the name of the finance minister of the USA, of America? If you have, if maybe one of you would like to raise your hand if you know the name of the finance minister of America. All right, neither do I. That's okay. Why? Because we all know the name of the chairman of the Federal Reserve, who's Yellen. Yellen. I may have pronounced it badly, but the spelling I think is correct. She is the most powerful person in America and probably in the whole world, at least in the economic sphere. Well, do you think she wants the American markets to crash the stock markets? I doubt it. I mean, unless she's a hidden, sort of a sadist who really wants, I don't think she wants that, whatever else she wants. Her full might of the Federal Reserve cannot stop American markets from falling, as they have been. The entire ECB cannot stop the European markets from falling. Let's forget about Europe and America, because at least they are democracies. So maybe there are challenges to democracies. As India, we know very well the challenges. Let's talk about China. In China, last year, just to share with you, what happened was that the Chinese markets were going up every day. So from 2,500, their index went to 5,000, and the government was very pleased because that's how the Chinese markets should behave. I mean, it's a resounding vote of confidence in the government. The market goes, every day you come into the market and you find it's gone up 1%. Why has it gone up? Because the government is doing its job. Fair enough. Somewhere in August, the market started falling. One day they fell 10%, and the government thought that maybe it's something unusual. And then they started falling 10% every day because they were hyped up and they came to levels which were absolutely unsustainable. एक रुपए की चीज है, if something is worth 1 rupee and you price it up to 10 rupees, it's still worth 1 rupee, na, government or no government. So traders are far smarter. The Chinese government got angry. They said, how dare the markets bring down the prices of shares? You know what they said? They said, anyone who comes and sells shares will be put into jail. Now that's a simple way of stopping a decline. You put them into jail. The end of the story. Markets did not stop falling. Every time the Chinese would release, when I say, okay, the markets are free and fair, markets will fall. And China from 5,000 has come to 2,500. That's the, here is a government which is, well, to put it mildly, not democratic. They can do whatever they want. They actually started putting people in the jail for selling their shares. Suppose you own some shares and you want to get your sister married or your daughter married, or put some money for your child's education, and you go and sell your shares, and then you realize, hey, I am in jail. But they did it, and they couldn't stop it. So my point is that markets are crowds. They consist of humans, and human emotion is far, far superior than the numbers that we crunch on spreadsheets. There is no comparison between a group of humans having group thinking and a number that is produced from a spreadsheet and said, we are going to grow by 7.9% this year. We'll all find out. Okay. What's really happening on the ground, on the earth, in the factories, in villages is really what's happening. We can say whatever we like with numbers. Numbers have limitations, but the crowd, the market has no limitations. Therefore, technical analysis says that we follow what the market is doing, what the crowd is doing, because the crowd is right. It is their perception which eventually drives the market. How do the crowds convey their message to technical analysts? By price. After all, if I think that the price of a share is going up, I'm going to go and buy it. That sounds very reasonable. If I think it's going to go down, I'm going to sell it. So what better tool of identifying what the crowd wants, what the market wants, than to analyze the price movements? That's the basis of technical analysis, and as I've just told you, the only purpose of TA is to identify price movements, nothing else. If you want us to do some insurance calculations or teach you how to do, say, calculate present values, nothing doing. There's only one purpose. So it's a very small subset of the financial management area, and I'm only talking about that very, very small subset. You must understand there's a much bigger world than TA, technical analysis. I'm focused only on this small area. So it's forecasting of prices based on how price patterns have been developing. If we have a pattern that says markets should go up, and that pattern is developed out of price movements, then the technical analyst will say, okay, I'm looking at a price that will be higher than what it is today. And how does that benefit us? You can buy that share, you can buy that commodity, or you can buy the currency, or you can buy anything that is liquid and for which forecasting can be done. So if we are investing, if we are trading, then technical analysis certainly helps us a lot. I'll give you a price forecasting example of how technical analysis actually works. This is a real-time example. It's something we have used, we have talked about on TV. So it's not simulated, it's absolutely real. I'm going to show you a price chart of the Nifty. All of you know what the Nifty is. The Nifty is the NSE 50, which is the benchmark index for the National Stock Exchange. And the Nifty is also the most widely traded derivatives instrument in India and extremely popular abroad also. So if you want to take a bullish call on India, usually you would buy the Nifty. If you want to take a bearish call on India, then you would sell the Nifty. Or it's not a bearish call on India. If you had a bearish view for the next 3 months, then the easiest way to convert your views into action, into an actionable idea, would be to go and short the Nifty. I'm assuming that you understand the meanings of short and long. Long is to buy and short is to actually short sell, which means you sell something that you don't own. It's possible only in the financial markets. Financial markets are wizards. They have created so much innovation which we cannot imagine otherwise. So I'm showing you a price chart of the Nifty. This is the point in end of August 2015. At this point, analysts such as me detected a bearish pattern on the chart. That pattern is not something, unless you follow technicals and use them, you wouldn't know about it. So you just have to trust me, and when I say that there is a bearish pattern on the chart. Okay. This was in August 2015. Now this bearish pattern tells us that markets, or rather the Nifty, should be going down. And this is the pattern. It's something we call a head and shoulder. What it tells us is that markets are distributing here. What is distribution? Smart money is selling out. Smart money sells out not because all of them collectively have a meeting and then say, we are all smart and let's sell out. Independently, they develop the same perception that markets are overvalued, or maybe the American economy is going into a recession which will affect India, or maybe they think that other asset classes have better values. Each of the people can have different perceptions, but collectively their action comes into the market in the in the form of selling. That's what I'm saying. This pattern tells us that smart money, people who know better than us, and some of us are smart money, not in terms of the worth of money, but in terms of our intelligence and application to the markets. Wise people are selling. This is a pattern that tells us this. If wise people are selling, if the price pattern is giving us an indication that markets are likely to go lower, then the correct action here is to go and sell the Nifty, to go and short the Nifty. When you go and short the Nifty, it is not a reflection on the Indian economy or on the Indian people. It's just a trade, that's all. We are not selling India short. We are selling the Nifty short for a particular period of time. At that point, the price was 79.50, and the idea was to sell the Nifty at 79.50, and the targets for this pattern were 69.50. I have been talking about this pattern on and off in my morning shows on CNBC. I don't do it every day because it becomes very depressing. Suppose the Nifty is at 7,800, and I keep on saying it will come to 69.50. One of the questions is, can I be sure? And the answer is obviously not. How do I know? I only have a pattern and a target, but the market decides where it wants to go. But so far as the pattern is valid, we are bearish on the market. Now, as luck would have it, the markets fell and reached the target today. Actually, they reached 69.76 yesterday. They've reached 69.50 today. It's just a matter of chance that this happens. Sometimes technical analysis works